Welcome to today's masterclass. My name is Lisa Richter and I will be your host today. On the off chance that you don't know about CSIA, we are a global nonprofit trade association with over 500 member companies in 35 countries. For system integrator members, the CSIA Best Practices Manual and CSIA certification are some of the more popular member benefits, but they also enjoy a variety of others, including professional development, learning from their peers, and access to professional services experts, including insurance, financial, and legal, who understand the SI's unique business needs. For partner members, CSIA offers an ecosystem to grow their SI programs, understand their customers' pain points, monitor industry trends, and share their thought leadership. With thousands of qualified integrators and suppliers, the CSIA Industrial Automation Exchange helps SIs, industry suppliers, and manufacturers connect and do business. For SIs and partners, it provides a platform to support your content and SEO marketing efforts, position yourself as a thought leader, and nurture prospects during their complicated buyer's journey. The good news is that we are now halfway through the year, and both membership dues and exchange profile upgrades are prorated, which is just a fancy way of saying they're half off. We have put together a first-timer package for companies that join in July and August that includes some new member benefits, including an EPUB of new products and services called Innovation for Integration. This package includes a free listing in this new EPUB, but also some other goodies to help you get your message and brand in front of your customers. Get all the details at www.controlsys.org/shine. At this time, I would like to introduce today's speakers, Tim and Brian. Guys, take it away.
Great, thanks, Lisa. I'm Tim Finnerty, and I run our industrial automation practice here at Clayton McKervey. Clayton McKervey is about a 70-person CPA firm that focuses on tax, accounting, and especially on the consulting side of the business. We have an industry focus in industrial automation, as well as manufacturing, distribution, and engineering services. My colleague, Brian Prozik, will be speaking as well today, and we're very excited about the financial checkup, optimizing your SI or system integrator business. Our agenda today, we'll first kick it off with Brian, and he'll do a quick introduction with the CSIA Financial Checkup, and then it will move back to me for the employee retention credit, and then a little bit on Biden's proposed tax plan. A couple of quick housekeeping items. Make sure if you have any questions, there's a Q&A section down below that you can ask those questions, raise a hand, anything like that, and we can get to you. So we're looking forward to letting you know a little bit more about our exciting new CSI Financial Checkup program. Brian?
Thanks, Tim. So yeah, as Tim mentioned, many of you may or may not be aware of the new financial checkup program that we've set up with CSIA for CSIA members. But rather than just spend 20 minutes here giving you an infomercial on it, we kind of wanted to go through a little bit of the background of kind of how we landed on the services that we intend to offer, and really hopefully give you some ideas or thought starters of ways that a integrator could better run their business. And one thing that we've noticed in our almost 70 years of working with small to mid-sized businesses, and then especially over the last 7 to 8 years that we've been working with system integrators, a lot of small to mid-sized businesses encounter the same challenges as they go through growth. And some of the biggest ones that we see here is their financial performance, understanding their financial performance, how are they doing well? Are there things they should be doing or things they should stop doing? Accounting systems always is a major hurdle for a company as it grows. You'll see most companies start out with like a QuickBooks type solution, and there's always that question of when did we grow out of it? Are we using it to the its fullest extent, et cetera. Tax compliance is a big issue. Everybody comes to us asking, how do we pay less in tax, or but really it goes a lot further beyond just the annual compliance filings. And then any business cash management is always a challenge. Particularly I think as you look back over the last 12 to 18 months, cash was a priority for everybody, trying to understand where they were at and how things were going to proceed throughout the pandemic. So I'll dig into each one of these in a little more detail. As Tim mentioned, if you have any questions about anything specific here, feel free to enter those in. But really starting with financial performance, oftentimes we get questions from CSIA members and other industrial automation companies we work with, what should I be tracking? How do I compare to peers and to other clients you work with that are in this area? And really for us, the conversation always starts not with, how you compare to peers or how you compare to others in the industry, but it's really how do you compare to yourself? So that's always probably the first place we start with clients is let's first make sure that you've got good, consistent financial data for your business to understand, when things, start to tick up. Is that because the business is really growing, or is it just, you're recording your revenues based on, when you ship the product out the door, and therefore you see these spikes and valleys, depending on when you invoice. So really helping clients understand their performance first. And then once we've got a good handle on that and they know what metrics they should be tracking, what things they should be evaluating, then you start to expand that out and look at the larger group. The CSIA and the Pulse survey, provides some very good information for business owners to be able to evaluate the performance of their business. But to me, it's not a pass-fail thing, right? If you were to go in and you look at utilization within the Pulse survey and compare it back to your utilization, that doesn't necessarily mean that you're doing better or worse, because each system integrator is a little bit different. You may be servicing a different industry for your end customer. You may have more of a software or a panel content, or you could have more of a machine build, content in what you sell to customers. So all those things impact. So it's then taking all that information you've gathered about yourselves, and then now trying to understand how you compare to others in the industry. So this is an area where particularly of late, we've spent a lot of time with customers, clients, trying to help them understand, how am I performing? How could I be performing better? How do I track this? Then the last point there is like, how do we use this information? I think most system integrators know, based on the industry you're in, all of your clients are collecting a ton of data, and they're probably asking you for, dashboards and visualizations and all these great things, but do they really understand what it is they're trying to determine and to see? And so we see the same thing on our side when we're working with business owners. So, that's, kind of some of the main points we see in working with clients on their financial performance. Accounting systems, we get this one all the time of, hey, we think we've outgrown QuickBooks, but we're not sure what the right next step is. We're not quite sure if we need to upgrade to a NetSuite or a Dell Tech, or any of the other myriad of products out there, and it's very we found it can be very cumbersome and challenging for a business owner to try and weed through all of that, because when it comes right down to it, the vast majority of the clients we work with, their background is in engineering. Controls, systems, mechanical, electrical, whatever it may be. They didn't go to school for accounting or finance or accounting information systems. And so it becomes very challenging to determine if you have the right system. Is it just a matter of that system not being set up properly? That is probably the first point where we start with any client is, okay, let's understand where you're at today. It's probably very similar to a lot of the assessments that you're going through with your clients when they ask you to come out and quote on a new system is, hey, but before we do anything, let's understand what you're doing today. Where are the bottlenecks? Where are the inefficiencies within your current processes? And then let's understand, is that something that can be addressed by just setting up the system more efficiently, more effectively? Or have you really reached the limits of the capabilities of that system, and now you need to start looking at what the next step might be? That oftentimes we see there's a lot of those things that can be addressed by just using the system properly, using the software properly. Again, many of the small companies starting out will start with a product like QuickBooks, and they're just doing the bare minimum to get information in so they can file their taxes, they can do those kind of things. And then once you've got the system running, it's very difficult to change or you don't even think about changing. It's just the way you've always done things. So a lot of the challenges that business owners see, reporting, being able to break things out by different product lines, things like that. Most of the softwares have the capabilities to show some of those things. It's just a matter of making sure you've got everything set up properly and are able to work on that. So, we work with a lot of clients to kind of make those kind of decisions. But even beyond the accounting system or the ERP, there are so many other software solutions that have been developed, that we're aware of because we're in the industry. And I've listed out here, artificial intelligence, RPA, machine learning, but there are add-on applications for almost any accounting system that will automate your payables process. They'll automate your receivables process. Take a lot of that manual data entry work. Again, I think that's one of the interesting correlations to me between what's going on in the accounting industry and what system integrators do. Is it's a lot of the same things. You've got a lot of manual processes that can be automated now, and then get the bookkeeper that you may have focusing on some higher order, more value added things than just keying in accounts receivable or accounts payable. There's a lot of applications out there that can take care of those things. So once we've kind of got that base groundwork established for companies, now you start looking at what are the add-ons, the visualization softwares. Power BI is one that a lot of businesses are using. Rather than having to go out and manually generate your financial reporting, can you have an application like Power BI go into QuickBooks, extract the information you need, and now you've got real-time visualizations of how your company is doing. So working with clients to try and identify those areas and figure out what's the right roadmap for growing their accounting systems to match the growth of their operations. Tax compliance, that first bullet point is probably the biggest one that we hear. You see a lot of business owners that, I was talking to another friend of mine that owns a business and they're paying this much in tax. Why am I paying that much in tax? And so often the conversation is centered around that. How do we bring that tax bill down? But really, it's a much more complex and nuanced conversation. And it's really focused a bit more on that second bullet point is what is your short and long-term goals for the business? Is this something that you want to be in for the next 2 to 5 years and then find a buyer and exit and then move on to whatever your next opportunity is? Or is this something you plan on growing and developing and you would eventually want to, pass down to your kids or something along those lines? Because those two scenarios would really potentially dictate two completely different tax structures. And as a result, you could have different tax liabilities at the end of the year based upon how things were decided to be structured. So really it's a big part for us of understanding what is a business owner's long-term objectives, what are they hoping to accomplish, and then what are the areas within the tax code. We work with a lot of clients on research and development tax credits, right? That's an easy way to free up some cash flow, in the short term. But are there other things out there, other programs or incentives that you can take advantage of? Tim's going to talk about the employee retention credit in a bit, but that's, another tax saving opportunity that freed up cash for a lot of business owners throughout the pandemic. So what are the things like that you can take advantage of, to try and help keep you going, keep you moving, and working towards your short and long-term goals for the company.
Hey, Brian.
Yeah, Tim.
Brian, just one other thing in there. I mean, one of the things related to this checkup, that we've found with other companies, both in CSIA and before we started this, was that, when you first started your business, as Brian was saying, you looked at it and you said, all right, let's just set it up as a C Corp or an S Corp or whatever it was. But you didn't realize all the different complexities of what your business has become as it grows. And so I think one of the biggest things that we've found and have helped multiple companies within CSIA through this checkup program and before it is taking a holistic approach at really understanding what is it, as Brian said, what is it that you want now and in the future, but really taking to heart the understanding of, what are you doing with your business? How are you, setting it up? Do you have multiple businesses that go across different things? Do you what is it that you need? So this really is an opportunity for you as a CSIA member in this checkup for the tax compliance to really just get a good understanding and maybe some different ideas or thoughts of what might make more sense going forward. And I'll talk about this a little bit in the Biden stuff too, related to estate tax. So a lot of that gets, talked about. How do you want to, give it to kids or to other people, or how do you maintain control, but still get some of that out of your estate, especially if the estate tax goes down. So I think that's one of the biggest things within this tax compliance that could be very helpful to companies.
Thanks, Tim. The last bullet point I have here on the slide is probably, there's enough complexity coming down the line with, as Tim is going to talk about in a bit, the changes that the Biden administration wants to make to some of the tax regimes. But in my mind, even more challenging than dealing with all that is what's going on at the state and local level. And if you're a business owner or you're involved in the accounting and finance area at all, just how challenging this area has become, because not only do you have 50 different jurisdictions all managing their income taxes in a different manner, but then you add in sales and use taxes, and you got property taxes at the local level and all this other stuff. So that really can become a major headache for a lot of business owners, especially if I think about the typical system integration company. If I think of all the clients that we work with in system integration, there's not a single one that only sells to customers in their states. They develop a reputation for a particular type of work or servicing a certain industry, and next thing you know, you're getting calls from throughout the US to work on their stuff. And so now you've got all of those different states to consider and look at. And so in that area, if your current tax advisor isn't having a conversation with you at least on an annual basis, if not, more frequently than that, about where you're doing work, the states you're filing in, things like that, make sure you add that to your agenda, because the last thing you want is to have one of your customers go through an audit within their state. The auditors will request a list of all the vendors that they're purchasing from, and all of a sudden they say, oh, hey, we noticed this company isn't filing in our state, yet they're selling to customers in our state. And then the auditor shows up at your door. So that's an area that will only continue to evolve as states try to find ways to plug holes in their budgets. They're starting to get really creative with their tax regimes. So something to definitely make sure you're talking about with your advisors as you're going through. And finally, cash management. I think every time there's any kind of an economic downturn, the focus on cash becomes bigger. We saw it over the last, like I said, 12 to 18 months with the pandemic. But oftentimes what we see within our client base, and this isn't something that's unique to system integration companies, but you do see it a lot within small to mid-sized businesses, is they're really focused on that 1 to 3 month window, right? Do I have enough cash coming in to pay the bills that are due, to make my payroll, to do those kind of things? That's where you're looking at your traditional 12 to 13 week, rolling cash forecast or cash flow analysis. And that's important. Like, I'm not going to downplay that at all. I'm not saying it's not important, but it's just one half of the equation. Where we notice a lot of companies kind of struggle as they're growing, and where they need to start, focusing their energy on is beyond just the short-term cash flow is, what does it look like 12, 18, 24 months out? Because I'm sure, as you're all aware, and you've all been through, these negotiations with customers where based out of Metro Detroit, a lot of our clients deal with the auto industry, and the auto industry has notoriously bad terms, right? So you end up financing the work for your customer because their payment terms are so long, and yet your vendors probably want to get paid faster. So the way where we see that come into play for SMEs that are looking to grow, and system integrations companies that are looking to grow, is if you have a aggressive growth plan for your company, that we want to grow 10%, 25% year over year for the next 5 to 10 years. Are you going to have the cash to be able to finance that? Will you be able to, to live through those payment terms from your customer, while at the same time, paying your vendors, and then, factor that into your decision making and your negotiations with both your customers and vendors to ensure that you don't, you don't find you land this huge program that's, a game changer for your company, and then 3 months later you're trying to figure out how to pay all the bills because you've only been able to progress bill for a certain portion, but you're already starting to buy hardware and things like that. So really doing this, on a longer term, a 12 or 18 month horizon, to kind of think about, okay, what is in my sales pipeline right now? How much of that do I think is going to hit? And what's going to be the associated cash needs from an employment standpoint? Maybe if we hit 50% of those jobs, we're going to have to hire 1 or 2 more engineers to support that. So now your cash demand is going to go up. Are we going to be able to do that? Do we have maybe a line of credit we can draw on to help us get through those valleys? Or if we don't, and we see that we're going to have a potential cash crunch, now is the time to start talking to your bank about getting a line of credit or something else that will help you kind of work through some of those fluctuations. Because we do know, particularly from the customer side, you guys do see a lot of those fits and starts with cash, where you get a lot when you get a certain amount when you start the job, you get a certain amount at different points throughout the job, and then the balance when it's all signed off. So can you manage those fluctuations? Another important thing to do within that, especially as you're looking on that longer term time horizon, is not just to have a single scenario you're evaluating. You want to have, a couple different kind of the best case, worst case, and what we think is really going to happen, so that you've got some ideas of kind of what your upper and lower bounds might be. Because then if you start seeing that you have cash available, what's the best use of that, right? Are there vendors that have, early pay discounts that you can take advantage of? Are there other items of debt that you can pay off now because you have the cash? Things like that. You start to look at that. How do we put that cash to work for our company?
Hey Brian, on that before, right now, one of our clients, we've now kind of taken over. They had a controller that wanted to leave and go somewhere else, and we started jumping in and handling some of that, the day-to-day accounting. And during that time, we found that they weren't managing payables and receivables correctly. So then, because of that, we started to put together this cash management, found out that based off of projections going forward, they're going to need some additional, availability on their line of credit. So we've been working with the bank as well, putting some forecasting and different things together to try to free up some of that availability. And because of us jumping in there ahead of time, when we did, I think it's been a great, we have a good relationship with the bank. It made it that much easier for the bank to kind of go, okay, now they got the right things going on. They know what's happening. Company's making money, but it's short on cash, right? Because of the timing of different things. And so I think those are the important stuff of getting in front of it, because if you're not in front of it and you need it tomorrow, it's not going to happen. Right. And so that's where it's like, all right, what are we thinking? And let's start planning for it.
Exactly. So that brings us to the affinity program. So when Jose and the board approached us about trying to set up, some sort of affinity program for members, these areas kind of stood out to us as probably the best areas that we could potentially offer some value. So if you haven't checked out the program on the CSIA website, we essentially offer some services in these 4 areas at special member pricing. And so if one of these things kind of resonated with you, you said, hey, that sounds like our company exactly. Or even if it's not one of those areas, we had a member company reach out to us for the financial checkup. And as we went through our initial call, what we really found was, hey, based on everything you're telling us, your real need isn't in one of these 4 areas. It's kind of this other affiliated area. And we came up with a program unique to what their need was. So, feel free to reach out to us. We'd love to just hear more about your businesses and the challenges you're seeing, and see if there's anything we can do that might be of value. So with that, I will wrap up my infomercial and hand it over to Tim for all the exciting points that everybody else is here to learn about.
All right, thanks, Brian. Again, if anyone's got any additional questions on the financial checkup, please go ahead and still put it in the Q&A down at the bottom, and we can hit that at the end, or take a quick break and add to it. So I'm going to start talking about first the employee retention credit. I think most people have know about it. But it's really changed for 2021, right? So when we take a step back and talk about employee retention credit, it came out in 2020 with the pandemic in conjunction with the PPP. And at that time, it was like you would take some of the PPP or the ERC, depending on what was happening. Well, 2021, they changed how you became eligible for it, which, for example, they reduced it from gross receipts, 50% reduction to basically, you needed a 20% deduction. So for example, right, in Q2 of 2019, I had revenue of $2 million. Now in Q2 of 2021, I have revenue of $1.5 million. That's basically a 25% reduction. I qualified. And if I qualified in Q2, I automatically qualify in Q3. So it can be definitely lucrative in looking at it. And the employee retention credit now can be used as well as the PPP. The biggest concern is you can't use the same wages. But if I had somebody that made, basically $20,000 in a quarter, which would be an $80,000 person, I could use the first $10,000 on the ERC, get a credit for 70% of that, and then the remaining $10,000 could be used towards the PPP forgiveness. Now, remember, under PPP, you get more than just wages, right? You can have rents and supplies and other things, but you have to use 60% of wages, right? So they also increased, the requirement from 100 employees up to 500. You do have to aggregate them within all the affiliated companies you have, but the majority of CSIA members fall under that 500 employees. There's also an advance credit, knowing that you're going to qualify, let's say in Q2, and you automatically qualify in Q3, you potentially can ask for advance payment in Q3 because you're probably already into Q2 when and we're done with Q2 now, but you could do that. So if you also qualify in Q3, you may be able to ask for advance payment in Q4. However, some of the things that we talk about is just either carry forward your Q3 and just don't make any deposits and start looking at how you calculate that to keep that cash in your pocket. The other thing is on this, you can, Brian, go ahead and flip the slide. The other thing is that you can also go back. So if you didn't think you qualified, you didn't know about this, you can go back and do this calculation, on your Q1 to see if you qualified in Q1. And if you did, remember Q1 and Q2 would automatically be included. And then you would just go back and amend your 941s. And this is, again, a very, it's meant to, because of, what we're seeing with some of our clients, especially in Q2 that are qualifying, is because there's been so many supply chain issues out there. So a lot of companies have had delays in projects, timing of getting stuff done. If you can't get materials and different things, if you're on percentage of completion or anything, you're probably not recognizing that revenue. So there's an opportunity that's here. And then the other biggest thing, right, is that this ERC is out there to continue to keep your employees, right? So let's say you got round 2 of PPP. That may just qualify for, get you through first and second quarter. Well, now you're still struggling with sales in the third and fourth quarter because of supply chain, but you want to keep all your people on. This gives you that ability to make sure you're keeping those people on. It also, when we think about it, you have a maximum credit of $28,000 per employee, which is basically $7,000 per quarter off of that $10,000. And in reality, if you do this too, it has the ability that you're able to keep up with wages, with what other people are doing. The big companies are really trying to poach other people because they're what we're seeing is they're putting their wages at a much higher level. So if you can qualify for this, maybe you can even use this as a little bit of a bonus system in some ways, to keep those employees, even though your revenue isn't there. Now, the one thing about ERC that's different than PPP is that ERC is taxable, right? So you want to make sure that you maximize your PPP forgiveness first before the ERC, because the ERC can be taxable. Now, depending on your cash position, again, there may be a reason that you don't maximize PPP and you maximize ERC, right? Because PPP becomes a loan that you have that cash at 1%, but you still needed the ERC cash to run your business. So that, that's another thing of how you're looking at what you may need to do. One of the other things for a lot of CSIA customers or members is that they take advantage of the research and development credit. If you're utilizing ERC wages, it basically is an offset where those wages will not be able to be used as research and development. So if you had $10,000 of wages for a person that qualified 100% in that quarter, that $10,000 would not be counted. Now, if they made more than $10,000, they made 30 grand in a quarter, you would reduce that down to 20, for that quarter that they would be able to qualify for the R&D credits. So a couple things that it may do is it may lower your credit for 2021, but it potentially could increase your credit for 2022 because those wages probably would be there the same. Your base goes back up, and your calculation could be a little bit higher. So that is kind of the ERC in a nutshell. So if anyone's got any questions, feel free to reach out. We'd be happy to talk about it. We're working through a client that's got about 8 affiliate companies trying to maximize both PPP and ERC, and it can be cumbersome, but at the end of the day, it's well worth it. If you're getting, a $280,000 credit and it's costing you, some time for some experts to review it, I think it's well worth that time. And that's $280,000 for 10 employees, right? If you had 100 employees, that's $2.8 million. We are seeing some of our clients, getting over $1 million a quarter, on the ERC as well. So just good food for thought, taking that step back, because effectively what Biden was trying to do, or what Congress was trying to do with this ERC was, if you are still struggling, but being able to keep your people, right? I mean, it's the hardest thing to go out and find new people. It probably costs you more than $28,000 a year to find, a new person, based off of time, recruiting fees, things like that. So that's really, why this employee retention credit was put into place. All right, so moving on to Biden's proposed tax plan. So he's got a few different things in his plan. Most, I think, from a tax standpoint, are not what business owners want. But we'll kind of go through it. Hopefully, by the time it gets passed, it's changed significantly. But there are some different things in here that need to be thought about and really looked at potentially before year end, right? Just in general, marginal tax rates are going up to 39.6, which is from the 37 that it's at right now. That's going back to what it originally was. And then it's also going back, it then applies at $500,000 basically as a married individual. So you're going to pay a few more dollars on that. We don't know if he's going to add back in some of the deductions that the old one, like the SALT limitation was $10,000 right now. If he, and so if he adds that potentially back in, that you get that deduction, then maybe it's similar to the same. Long-term capital gains, which is the biggest one. He's looking at, $1 million. If you have $1 million of ordinary income, any of your capital gains are going to be taxed at the 39.6 plus this 3.8% net investment tax. So you're basically paying 43.4%. And then depending on which state you're in, you could be paying another, 4 to 12%, 13%, right? So you could be paying in excess of $50,000. You're also paying, 7.5%, on your wages that are at about up to about, really 50. If it's a pass through, potentially as a business owner, you're paying 15%, for the Medicare and Social Security tax. So again, your tax rate effectively of what you're giving to the government can be significant. They also made announcement that potentially he's going to make this retroactive on the capital gains, which means it could be May 28th, which is when he had the budget reveal, or they said even April 28th, which was when the American Families Plan Act came out. Our hope is that he does not do that. I mean, that makes it much harder. I know a lot of clients that were on the fence about potentially selling. We're looking at trying to get the sale done this year, but if he makes it retroactive, it may or may not work very well. So that's another area. Pass-through income currently right now, pass-through income from an S corp is not subject to the 3.8% Medicare at all. What they're saying is if your AGI is over 400,000, then an S corp isn't going to make much difference than what a pass-through LLC that you're active in, which you would have self-employment income, which does have the 3.8% on it. Once it hits, I think it's 250,000 for companies or taxpayers right now. The excess business loss, this was brought into place in 2017. Really, it was for 2017 and 2018, and then we hit kind of the pandemic, and so you didn't see it as much. Where it was, you could only limit your business losses to about 500,000, then you would carry the rest forward, and you could use different things. That was set to expire in 2027. He's looking at potentially making that permanent. He's looking at expanding the earned income tax credit, which would make that earned income tax credit permanent. Some changes to the child and dependent care tax credits permanent. I mean, some people have been seeing that they're getting monthly child tax credits right now. He extends that child tax credit increase through 2025. He wants to now make it permanent. And then some additional items related to COVID. The current proposal still doesn't eliminate the qualified business deduction. So like, for example, right now, companies were basically getting that 20% deduction. Right now, that's still in there. So if you made $1 million, you're really only paying income on 800,000. And then you pay at the, at whatever tax rate that you're at that point in time. All right, next slide. So the state and gift tax, I know this is something that, a lot of times you're not really thinking about until you have a big event. And and thinking about retirement or different things. But this has to do with, how does the capital gain change? So depending on that, if it increases, you're basically talking about, a 43% rate over the $1 million. Now, if you potentially gift some of your ownership to kids or different things like that, and their income on those sales, let's say it's 10% of the business, their income on that sale ended up being $900,000. That's really all the income they have. They wouldn't pay that capital gains at 43%. So there is some reasons potentially to think about gifting, depending on how much value you have in your business, right? When you're doing gifts right now, the valuation usually has some minority discount and marketability discount. So let's just say your company's worth $10 million. You potentially could say it's worth, $7 million, and then you're gifting 10%. So that'd be $700,000 that you gifted away. That's getting that out of your estate as well, especially if they reduce, potential estate taxes, right? Right now we're at $22 million with your spouse, 11, I think it's almost 11.5 with inflation. So it's almost 23 million. And so, those are things to think about of what you're doing. They're also looking at, getting rid of some of the step up in basis upon a death. They are looking at an exclusion here of potentially $2 million of, unrealized gains. So if you had, if you had stock in your portfolio that you've had for 50 years on something that's appreciated by $2 million, upon your death, you would get that $2 million step up exclusion. But like in your business as well, if for some reason you didn't sell it and you died before you sold it and you didn't transfer any of the stuff, they would do a valuation. And if that business was worth $10 million, you get a $2 million exclusion, but then there'd be a $8 million gain that potentially could be taxable, depending on how you've structured everything to get it to the next generation, right? So the estate side of things, even though you might not be thinking about a sale or doing anything, you're still growing the stuff, it could be a huge area to potentially have to think about right now. A few other items, he wants to, a lot of people have heard about this, right? He wants to increase corporate taxes from 21% to 28%. He wants to, that would be after the current year. He also wants to potentially impose a 15% minimum tax on worldwide income. So this isn't going to affect too many of the CSIA members, but anyone that's got, affiliates in other things, or if you're trying to offshore something, that's where they're talking about this 15% minimum tax. It's referred to as a book tentative minimum tax. So there could be some credits or different things based off of some other stuff on it. He's also making this effective after December 31st, 2021. Now, the proposed changes on the corporate stuff, I think, could be offset by, Brian, go ahead and flip to the next page, is he's got some new general business credits for onshoring or keeping business here. So they could effectively, we haven't seen anything, there hasn't been anything written on this stuff, but effectively there could be something that kind of offsets that 28%. But remember, if you're a corporate, if you're a C Corp, and you're still paying at 21%. Effectively, anytime you take a dividend, they use capital gains, but anytime you take a dividend and potentially if that dividend causes you to be over that $1 million, you're going to pay an additional 43%. So effectively you're paying 21% plus then now 43%. Now you're talking about, you could be at, with state taxes, at closer to 70% of, tax rate, once you take that dividend out. So, again, is the corporate structure the right thing for you? Who knows? And we don't know as well for regular pass-through companies whether or not he'll be giving any sort of general business credits, but I would think so. And there hasn't been anything in here related to the R&D credit. We assume that the R&D credit will stay. The question is, will it stay the same way that it is right now, or will they make any changes to it of how it gets utilized or what happens with it? And then if you're moving jobs out of the U.S., there's going to be potentially some reduced tax benefits for that. I think the question gets to the point of, how do you, if we can't find employees here and nobody's working and we don't have enough staff, how are they not going to let you potentially utilize, Mexico or other things, maybe for low non-value added type services, or, for manufacturing type stuff that can be done. More of it's probably going to be maybe a boon for the automation industry, where the manufacturing companies here, if they're getting big enough credits for onshoring work, that they put in automation systems that allow them to have less people, but somehow they're getting credits for it and will offset any of that expenditure that they're having. The biggest thing that's going to be is, can companies, smaller manufacturing companies, get financing for this CapEx that's effectively going to put a lot of debt on their books right away, compared to their debt to equity, what they currently have right now, because most of the stuff is being done on a manual basis. So I think that's it. I'm not seeing questions. We'll give a second here to see if anyone's got questions, but we really appreciate the time that you guys took out of your schedule to listen to us. Hopefully there was some good information that we had, and we left the contact information up here. I'm sure the slides are going to be available, as well as the recording. And Lisa and CSIA, thanks again for inviting us to do this. And thank you.
Thank
Sure.
you.
So Brian, we're gonna we have a few more slides that we want to put up. So
Yep. I just need to get my controls back here. Yep.
Thank you, Sandra. I know the handoff can be a little tricky. On behalf of CSA, I would like to thank Tim and Brian for this informative discussion, and of course, thank you for attending. I'd also like to remind you that, as Tim said, a recording will be available for viewing within the next couple of days. And finally, be sure to bookmark the CSIA events calendar so you don't miss any upcoming events. As the guys mentioned earlier in the presentation, we do have more information about the financial checkup program. I threw this slide in just so you could see where you could get that vanity URL to get you there. And then that's it. This concludes our program for today. Once again, thank you for joining us and have a great day.
Thank you.